Great. So now let's look at the question solving stage of the conceptual and the regulatory framework. I'll scan through from 2010 up to date the question solving of the conceptual and regulatory framework. So question solving stage. So questions on the conceptual. So let me do this way. On one, the conceptual framework. Two, the regulatory framework. So that is the game. Now let's go to the question. So let's visit our material. So let's see the questions in here. So question one, look at explain the difference between the conceptual and regulatory framework of financial reporting. Right, that's the first question. How do we approach this? Okay, so basically, they are just looking at the difference between conceptual and regulatory framework. Tell the examiner that with a conceptual framework, it's made up of what? Or a set of principles or assumptions or concepts or ideas that form the basis of financial reporting. That form the basis of financial reporting. Great. That is the conceptual framework. Go further. Tell the examiner that it gives the limits, the objective of the financial statement that we are preparing or financial reporting. It gives what? The limit, the objective of financial reporting. Go further again. Tell the examiner that it deals with issues such as what? Qualitative characteristics, the underlying assumption, recognition and measurement of elements in the financial statement. That is how you solve this particular question. So that is just the conceptual framework section. The comment talks about the regulatory framework. Tell the examiner that this is a set of what? Rules and regulation that guides or binds the financial reporting. And these rules can be locally or international. For instance, if you take the regulatory framework of Ghana, we have our companies code. Each and every country, their Companies Act prescribes certain rules that the company that in that country should adhere to in reporting. Should give some reporting rules. Again, international regulations such as what? The IFRS is also there for us. And then the stock exchange requirements. That is all. So we are done with this particular question. This is how you should go by. Good. Now, B, define and discuss the fundamental and enhancing qualitative characteristics of accounting information. So define and discuss what are the fundamental qualitative characteristics. So the fundamental. So it's not like this. B, third examiner, that fundamental qualitative characteristics is the qualities. So it's the qualities of features that makes the financial statement useful, or the financial information useful. So any feature that makes the financial information useful is what? Fundamental. Then you give the two main. They are: one, faithful representation. So faithful representation. This include faithful representation. Two, and relevance. Then you click each of them and talk about them individually. So let's go. Faithful representation. Here we are saying that the financial statement prepared must represent economic reality of the entity. I like that too. The financial statement must represent, or must represent the economic reality of the entity. It must represent what has actually happened, not what they think. Oh, sorry. It must rep the economic reality of the entity. In short, it must represent what has actually happened or transpired within the period. The financial statement must represent the actual substance. For that matter, the financial statements or the transactions and events must be reported at their substance but not the form. Full stop. Then my last but one point will be as follows. Now, when you talk about faithful presentation, it means that if we are presenting financial statements and we've quoted assets, any asset stated must meet the recognition criteria. So all items stated, or all transactions and events recorded in a financial statement must meet the recognition criteria. So each and every item have recognition criteria. So before you record that item in the book, it must meet that criteria. Okay. So that is it. Now the last point that I'll state about the faithful presentation is this. So I tell the examiner that to report faithfully or to increase the faithfulness of the account of the financial statement, the transaction or the financial statement must be one, complete. Two, it must be neutral or unbiased. Three, it must be free from all material errors. Then finally, transaction must be reported at their substance, but not the form. So these are the items that will improve what? Faithful presentation. That's all. Then you talk about relevance. We talk about relevance. If you need more, you can visit the previous lecture to gain more about this. Okay, then you talk about relevance. Relevance simply means the financial statement or the information that we are presenting, it should be able to influence the decisions of the entity. It should provide all the decision needs of the entity. So relevant information, it should help the user, one, to predict the future, two, to confirm the past. And don't forget that it's boxed on by what? Materiality. You are done. So that's the end of the fundamental qualitative characteristics. Then you go to B. B. So all this is for just 1 point. We go to the next one, enhancing. Enhancing qualitative characteristics. So what is that one to enhancing? Enhancing, they are 4 in number. Enhancing are 4 in number. So make sure that you're fine with the 4. Enhancing are 4 in number. So first on the list, comparability. Understandability. Or the 80-80, verifiability. The last one is timeliness. So these are the 4 enhancing qualitative features. That is all. We are done. So just explain them. The financial statement that we are presenting must be easily be compared to the other entities. For that matter, they must be consistent in the accounting policies and the assumption or the estimate. And there must also be a disclosure. Understandability. The financial statement must be readily understood by the users. For that matter, the users have a reasonable knowledge about the operations of the entity. Verifiability. The financial statement must be easily verified by a third party, usually the auditors. Timeliness, it must be on time. Not too early, not too late. That's all. We are done for that particular question. Okay, so we go to the third one, which says that assess the advantages and the disadvantages of each measurement basis from a point of a key user. From the point of a key user, from the point of a key user. Okay, so what are the measurement bases? So measurement basis, current. So the measurement bases are 4 in number: 1, 2, 3, 4. We have what? Historical cost. Historical cost. If you pick historical cost, you explain how assets and how liability. But here we are just asking for advantages and disadvantages in place of a key user. So key user, who will be the user? Maybe you can take shareholders or management. If you take shareholders, key user, shareholders, how will historical costs help them? Good. Now, it will not reflect the current value. So that means shareholder will not be much comfortable with the historical cost if the assets are being recorded at their original amount, not their value today. To worry the shareholders. So that is it. Now it means that it does not provide the current, the accurate current value of the entity. And if not, or you can't determine the current value, then we can also determine the current wealth of the shareholders. And that's the challenge that we have with it. The advantage is that the preparation of the financial statement will be done easier because the historical cost concept is so easy to be used. Then the next one that we talk about will be the current cost. The current costs have a good news. This and this oppose each other. Current costs have a good news. The good news is that it reflects the market value of the asset and hence reflect the market value of the shares for that of the shareholder. So the shareholder's value will not be under or overestimated as compared to the historical cost. Now the third point is the settlement, the realizable value or the settlement value. The realizable value or the settlement value. So in short, we just have to explain the settlement value or the realizable value. Then we go to the discounted future cash flows. Discounted future cash flows. Down to look at the advantages and disadvantages. For this one, the advantage is that that's the discounted cash flow. For an investor or a shareholder, it will help the shareholder to determine the value of the shares easily because you can get that by discounting all the future cash flows. Good. You do the same thing for realizable and settlement value. Then that's all. So this is how you answer the question. Kindly look at this question very careful. You are going to meet it most often in our discussion. Now let's go to the D. Explain the ISB standard setting process, so-called due process. The due process. So what's the standard setting process? In all this, you can visit the previous lecture video for a full version. Now the standard setting process, if you look at it just in a few minutes, good. So we said that the first step or the first stage is what? Agenda consultation and plan of work, discussion paper, exposure drafts, new IFRSs is issued, revision of IFRSs. Sorry, let's point it down. Let me jot it down. The stages, the process are 7 in number. Number 1, agenda consultation and plan of work. Number 2, discussion paper. Number 3, exposure draft. Exposure draft. Number 4, revision of exposure draft. Right. Then new IFRS is issued. Then adoption of new IFRS. New IFRS is being issued. Then adoption. After issue, there must be adoption. Then 7, post-implementation review. How to implement it. Post-implementation review. You can get a full section of this in the previous section in the previous video. So kindly visit the immediate one, get a full picture. So these are the standard setting process. Let's continue the question solving. A, outline and discuss the advantages and disadvantages of the international harmonization of financial reporting standards, the IFRSs. So there are advantages of international harmonization. So let me prepare them in the 9th table. Simple and easy to remember. So let's draw a 9th table here. Let's do something like this. Advantages and then the disadvantages of the IFRSs, that's the international harmonization. I'll talk about a few. Number 1, we said it improves comparability. So to improve comparability, so improve comparability, right? That's what we talk about. 2, we say expansion. If the IFRS is being harmonized all over the world, it will probably result in a standardized way of presenting financial statements. And in a way, it will improve and or enhance the comparison of performance. So financial statement prepared in that of Ghana can be compared to a financial statement prepared in UK, South Africa, and other countries. Expansion will be so easy because the system of reporting is still the same. Good. 3, easy access of finance. Easy access of what? Finance. It grants an opportunity. It gives some financial backing, can serve as collateral for financial finance. Most countries adopt it by way of loan covenant. The country is in for a loan, and then you'll be asked to adopt the IFRS before the finance will be available to you. We can also talk about reduction of audit costs, so reduce audit costs. It will reduce audit costs. It will reduce audit costs. Good. Then number 5, transparency. Transparency. There are 3 stubborn guys. There will be transparency in the accounts. There will also be accountability. It will enhance the accountability. Directors will now have to report on their stewardship. The accountants, the directors, the management team, with the help of IFRSs, are accounting for all the items that they hold in a trust, or the shareholders have entrusted into their care. And then the last one is transparency, accountability. If these two are there, then you use the resources wise. So it will now lead to what you call efficiency. So it will result in efficiency. So if someone is watching you, if everything that you do, you have to showcases, you have to tell the world that this is how you have prepared it. In a way, it will hold you on your toes or hold you firmly for you to now utilize the resources well. Great. Great. Now let's go to the challenges that we have with the IFRSs that deter a lot of people to boycott it. Challenge number one. The IFRSs normally does not support a lot of legal systems. So different legal system. Different legal system. Point number two, legal system moves with culture, different culture. So anywhere you write different legal system, just complete it to get 2 free points by adding the culture to it. So different culture. Point number three, with this, the need of developing countries. The need of developing countries. So need of developing countries. All these, you can get a full version in the previous lecture video. This is a question solving stage. We said that different legal system among countries would deter countries to adopt the IFRSs. Yes, so for instance, if we look at the legal system of US, legal system of the other Arab countries, it has not moved in line, directly in line with the IFRSs. Good. So such country will never adopt the IFRSs. Other than that, that country must what? Throw away the preserved and so cherish the legal status of that country and come and then take the IFRS loan. Currently in Ghana, the IFRS 10 conflict with the Companies Act. So if there are a lot of contradictions, do you think we'll be happy and use it? Then we will go back to our Ghana gap. Okay, we also said that a different culture, like culture, usually how people behave normally translate into their reporting directly and indirectly. So if their behavior translates into the reporting and it moves not in line with the requirements of the IFRSs, can be different. And the culture that we have on all the acts are different. Look at the culture of Indian, South Africa, Egypt, come to Ghana and other parts of the world. So if all of us use one item and we have a different mindset, different culture, some country cherish their culture so much to the extent that nothing can be exchanged for their culture. Take a country like China. They make the golden spoon, but they still prefer using their chopping sticks to eat. Yes. And Africa probably will go in for their spoons and stop using the hands. If you visit a Ghanaian restaurant, let's say in the urban city, and you eat with your hands, that will be the next news in town. But nothing will prevent Chinese man to eat with the chopping sticks. That is it. Now the fourth one we can talk about. Sorry, the third one we said the need of developing country. Now the developing countries don't need the IFRSs. It will not solve the poverty. It will not construct the road for them. It will not solve the injustice. The developing countries such as some parts of the African and then the Asian countries, they don't need the IFRSs. Why? But the IFRSs will not solve the poverty. The poverty in the country. It will not construct the bad road, will not turn the bad road curve. So if that country is seriously developing their primary base, that country will not adopt the IFRSs. Even if we sell the IFRS to him very cheap, he will never, because it's not ready. It's not in the right frame for IFRSs. If there are a lot of war in a country, people are running away from the country because the country is more safe for living. But that country gonna adopt IFRSs. Who will even be there to report? So what the developing country need is development. After which they will not think about service. They will not think about IFRSs. So if a country is seriously developing the country, the IFRSs will be on hold. Why? Because IFRSs is not a basic need. It's not a basic requirement. When we see the basic need, when the COVID-19 came, you all saw the essential workers, the basic needs. Good. So when COVID-19 came, IFRSs were at close to no IFRS, not even IFRS 5 or IFRS 1 was even working. No IAS. So that tells you that we have to focus on our basic needs. Probably the Western world, their basic need is what catered for. So if the basic need of the Western world is catered for, then they can now move ahead and go to the IFRS. That's why you see this IFRS is well established in the developed countries, such as the UK, the US, German, other countries where they are already developed. But the infant countries that they are now picking up small, small, if we sell this cheap to them, they will boycott it. So let's take note of that. Then we can also talk about nationalism. One country is not ready to accept other countries' item. Example, US have not adopted the IFRS. It's probably coming from UK. Number 5, lack of strong accountancy body. Lack of strong accountancy body. Accountancy body. If that country does not have an accountancy body that will enforce the use of the IFRSs, that country will not adopt it too. Even you having body to enforce it, people are misusing it. And now that you don't have anybody to enforce it. But thank God that we have ACCA and ICA Ghana to enforce the use of the IFRSs. So if that country's accountancy body is not strong enough, they might not be able to handle the IFRSs, the adoption well. So recently, if you read the news carefully about the bank's collapse in Ghana, ICA took it upon themselves to launch an investigation, and after which some of the audit firms were found liable and guilty and were found or fined some lump sum of money. That is it. So I'll add the last point to it. Training, cost of training and retraining. So training cost. So also serve as a disadvantage. Training cost. So these are the advantages and disadvantages of the international harmonization. You talking about them, and that's the end of the game. Let's continue solving the questions. I'll scan through all the remaining questions. Let's go to Target Foods Limited. I'll go straight to the requirements to avoid deviation. Required. Prepare brief notes for the finance director addressing each of the following and using the ISB framework as a source of reference. A. Identify potential provider of finance for Target Foods Limited and their information requirement in respect of the financial statement. Here, even though we have a general users, you are limited to what? Provided of funds. So basically, there are three people that can provide funds to Target fruit juice, basic. Even though we have many. First of all, we talk about owners, investors, shareholders. These are the three people. So the owners, what is their information need? Let's go to the board. There are three people that can provide finance or provide money to support the organization's operation. The three people are who can bring money on the table. Three people that can bring money on the table. Or, but there are many. Number one, the owners, yes, they can bring money. Or shareholders. Or investors. Number two, bankers or loan creditors or lenders or loan creditors. Loan creditors. Number three will be suppliers, those that supply the fruit on credit. Now, when you mention level like this, you should be able to provide their information needs. So what will be the information needs of owners, shareholders, investors? Investors are interested in three items. That's all. What they need. Three. Just that this part of the board is not coming. So three items that investors need. One, they need a profitability. That's the first thing that they will check. The profitability. Number two, they will check the return. Why the return? Because if the company make billions of profit, it's not for the owners. Until dividend is declared, you won't benefit. That's why we said that most company or most investors would like their wealth to be increasing. So second, the return. So return on investment, yes, on investment. How much are they getting? The last one that they will talk about viability of their investment. Maybe they place just $1,000 there in your business when you are operating just 2 towns or 2 cities. But now, what is the value of their investment? Is this 2,000? Has it yielded a good return? Maybe you planted just one seed, but now you have a lot of seeds available. So the viability, we are done. Let's talk about bankers, lenders, or loan creditors. So bankers, what would be their need? Bankers. Bankers first, they will take the gearing level or solvency of the entity. Before I give a loan to any company, I'll check whether they are solvent. Number one, solvency. Check their solvency, both short term and long term. So solvency, both short term and long term, whether they will be able to pay back. Two, the ability to keep within the interest payment. Ability to keep within the interest payment. Some companies, if you give them loan or facility, after they pay for the principal, the interest, that like don't pay again. Then three, I also check whether they can keep within the other terms and conditions. So other terms. That's all. Suppliers who move in line, just that they will check our short term. Everything here the same. Just that they are interested in short term. So that is it. Now let's check suppliers. For suppliers, they'll check about one, your liquidity position. Your liquidity position, your ability to settle your short-term debt as and when they fall due, your ability to generate enough liquid assets to pay for their suppliers. Time two, quick payment or prompt payment. So quick payment. Quick payment. And three is the same as this. Complying with the other terms. Other terms. That is all. So that is the answer to the question. So obviously now right after reading the requirements, now we are start solving it. And then that's the best way. Without going through the entire syllabus, the entire guide here. Sometimes the entire guide has not, you don't need any point from there. Let's go to the B. Explain the terms performance and position and identify which of the financial statement will assist the user to evaluate performance. What is performance? Now, performance simply means the organization's performance is measured in terms of profit or loss earned by the organization. Position is the asset or liabilities and equity that the organization possesses, or claims due to and due from the organization, due to and due from the organization. That is all. And then the statement for performance, that's comprehensive income or the profit or loss or the trading profit or loss. Then for position, the statement of financial position. Now, let's go to the third one. Indicate why for decision-making purpose, a financial statement alone are insufficient. Here, we are just asking you what are the challenges of the financial statement. So the financial statement that you prepared, what are the challenges of the financial statement? So the challenges of the financial statement, they are one, they are manipulated, or they can be manipulated by subjective accounting policy. So the financial statement that we are preparing is being manipulated by subjective accounting policy. So point number one, it can be manipulated. Manipulated by subjective accounting policy. Number two, it's subject to personal influence. Subject to personal influence. We can give an example. You know, most of the items in the financial statements are estimates, e.g., how figures are being estimated in the books. That's estimation. Some of the figures the accountants have to estimate, and if they give you the room, you estimate differently. It is also estimated what differently. So everybody estimate different. So that's what we say subjective or subject to personal influence. Then the third one is so it is based on past events. So it does not analyze the future based on past events. Past events. So recorded features. Recorded features. Okay. Based on past event and recorded features. Two, it does not reflect the non-financial activities or non-financial information, or it consider only financial information. Consider only financial information about the entity. If you are making decision, you should not consider only financial. No, you want to make a decision, consider both financial and non-financial aspect of the entity. Do not concentrate about the money. No. That is, again, the financial statement does not consider that of the non-financial. That is it. Okay, basically that is it. Can you go through the remaining one? In our next meeting, we will discuss the remaining ones. In our next meeting. Question 3 is yours. You can see most of the question has been repeated in here. In our next meeting, we will look at that. So thank you very much for coming. So kindly subscribe to the channel if you have not done that. So let's. So here we said big past events. Good. So thank you very much for coming. So we'll see you again in our next meeting. Good.